Working capital is one of the most complex concepts for business owners and executive teams. It sounds really theoretical, but it's pretty simple when you walk through the concept. Welcome to today's live stream, brought to you by Build. This will be recorded, so you can follow along to just learn or download the Excel calculator, fill it out as we go, and type questions in the comments for tips. For those who don't know who I am, I'm Josh Luebker. I'm a fractional CFO and COO for construction subcontractors ranging from $1 to $50 million. I help achieve sustainable growth through construction accounting and data-driven decisions. Over the next 40 minutes or so, we will focus on the data-driven decisions part and be going over the practical way to account for the cost of capital, building upon the previous Build Meetup on the theory behind it. We'll be using a cost of capital calculator to look at the monthly cost of working capital by client, and then calculate the cost of working capital for your next project bid. And then we'll finish up with how I determine as a fractional CFO which working capital options to use and when. All of this information is extremely personalized to your business, so please use the calculator linked in the comments. It's a fantastic tool to use with your specific historical data while I teach you how to use it. As we've been saying leading up to the event, you want to have your historical data for AR filtered by clients available, your interest rates you have negotiated with vendors, credit card interest rates, and line of credit rates. So have those accounts logged in or ready to reference. A disclaimer about today: this topic is very dependent on the data integrity of your accounting system. So if you see you need better data, better accounting practices are going to be your next growth step. And with that, let's get into it. All right, we're going to start with calculating the monthly cost of working capital by client. Do you actually know how much each client costs you in inflation, in interest, or in lost opportunity? You probably don't know exactly. And this tool is great, and it's going to help you quantify that. It honestly made my head spin to try to understand for quite a while, but ultimately it helps you identify your ideal clients, those you best align with for values, and you can offer the best bid to. Something to note is not every client should be getting the same bid, because not every client is going to cost you the same amount to work for. This first step helps you know which clients you need to prioritize working on relationships with and their bids, so you become more efficient with overhead. And as a result, you'll improve your win rate and your profitability. If you aren't familiar with the 2024 subcontractor market report, Build polls subcontractors annually, and they found that subcontractors who account for the cost of capital are 11% more profitable than those who don't. So this isn't just a theoretical concept that's wishful thinking. This is actually what many very successful subcontractors do. So let's start with entering your specific projects and your specific company data. We're going to start with tab number 1, calculating DSO and client costs. DSO, if you're not aware, is days sales outstanding. It's general accounting language, but just know that it's basically the time that it takes from when your company invoices to the time that it takes to collect on that AR and receive money in the bank. Every cell in yellow is what we're going to be editing. We're going to start with client number 1. We're going to enter all of the historical data that you have on average that it took to collect from the day of invoicing for each client up to 20 projects. As you can see, I have project number 1. The average collection time for client 1 DSO was 30 days. Project 2 is 25. Project 3 was 20, etc. This data It needs to exclude your retention billings. Those will skew the data you actually want pretty significantly. Another thing to note is it's important to know that the average DSO days will fluctuate project to project from quite a few things. They can make your data volatile and needing interpretation. So you can't just look at the values. A few of those examples are: what are the payment terms from the prime contract and your contract? How good is the project manager of the GC on that individual project on making sure their subs get paid? How well is your team billing and following up on those payments? What are the size of the projects? What are the project vertical types? And which owners? Are they private? Are they public? That all has a direct reflection in some of these numbers. And when you mix different general contractors with all of those factors, you might have some really big numbers and some really small numbers depending on the project specifically. If you aren't already, it's really good to track all of that data extremely granular like that, because it'll help you hone in this spreadsheet. So that way in the future you can be very precise and instead of being like plus or minus a percent or so. So I didn't highlight this specifically, but where it says client 1 DSO, you can actually name the client. So what I'm going to do is I'm going to name the first one ABCGC to show you later on how that affects the other tabs. So if you have the general contractor name that you're working for, go ahead and put them across the top, fill out the projects below. I'll give you a second to enter that data. Um, if you need more clients, if you have 30 clients or 10 clients or whatever that you work with, you can click the column letter of a column at the top that has a client on both sides, so the equations will update automatically. Right click and go to insert. You'll have to copy and paste the formulas over. That way they keep carrying on and they do the same things. If you don't have that many clients, if you have like less than 8, you'll notice the error equations at the bottom. You're going to want to delete those so that way your average DSO over the whole company works properly. So after you get all of your data entered, you'll see the green cells below labeled average client DSO. So what that is historically, this is how quickly your invoices get paid, filtered by client. So please leave a comment. I want to know, what is your average DSO for the client that you do the most work for? Was that what you expected? Or is that a bit of a shock? These numbers can range tremendously, and it's important to account for these hard to find costs that can tank your business, even though you're doing great work. Filling out tab number 1 makes it easy to just high level see which clients do I need to make a priority on based on actual data of how they're treating your business, instead of all those nice to haves and emotional decisions like let's go to lunch, um, or lunch at the job sites for the people, or golfing events, or a long history together. This actually tells you, are they worthwhile to pursue, or do we have, or the other way is it opens up a discussion of, hey, we've been working together for a long time, and because your payment terms are so long, it's costing me 3 point whatever percent more to work for you. So it'll help you in multiple ways if you want to keep working for a client. You'll see the cell in red was an error, but when we delete all of the extra equations that aren't actually doing anything for clients like 6, 7, 8 in my example, then it'll resolve. And what that number is your company average of every client you work for based on every project you've done and all of your historical data. That's how long it takes you on average to get paid from your clients. Depending on your company business model, whether it's payment up front and then you perform the work versus you do large construction with mainly progress billing, this will vary. So don't base it on everybody else's answers or your friends or other subcontractor owners that you know. Uh, just know that for progress billing projects, you want this to be 45 days or less. So a quick tip that I use to drastically reduce the average DSO is the ambiguity. There's so much ambiguity in your pay when paid clauses in the contract. So if you negotiate in after pay when paid or net 45, whichever is less, that helps you have a starting point of when you can have a discussion. So the selling point is you are helping the general contractor get paid from their clients on time as well. What typically happens is if it just reads pay when paid, you will never know if the general contractor's actually been paid. And so project managers will say, well, we haven't been paid yet. And so we can't pay you, obviously. But if you know that it's net 45, then as soon as net 45 hits, you can start to help the project manager, help the general contractor get paid. Or if they have been paid and they just are lazy with their accounting team, they will have to pay you faster because you're calling them out to the client with notice of non-payments, notice of intent to liens. It helps keep everybody accountable. But if you don't have that net 45 in there, if you don't say or 45 days or less, then you get into the problem of, okay, our state regulations are 90 days, and then we have to have filed something before then. So you wait till day 85. Well, obviously then your cost of working capital goes exponentially high, right? So trying to keep that low. So now that we have all of your historical data entered, we will go into tab number 2. We're going to calculate the cost on a monthly basis. So what this is going to do is calculate using an average interest rate by working capital type and their total balance that you typically carry on a monthly cadence. So the reason at this point we aren't going so deep into having each specific interest rate for each specific loan is because you're looking high level at how much does this general contractor cost versus another based on their average payment terms. And also based on your historical data of what's my typical balance that I just carry on each one of these lines. So you'll need to come up with your average interest rate. Pretty easy, add them together, divide by however many there are, and that gives you what you need. And you're going to update all of the yellow cells in column B. For this example, I'm using 9% for line of credit, 2% for supplier terms, etc. When you get to outside liabilities, these are going to be the other category of like equipment RPOs, small business loans, etc. They don't fit in those typical traditional categories. If just to show you an example, if we update the material financing to 5% here, you'll see the formulas update throughout the whole spreadsheet. And what that does is it quickly changes the bottom line. Even if you change from 2 to 5%, it's going to change you quite a bit at the bottom of how much they cost you every month. Next, we're going to update the average monthly balance. This is going to be what your balance is typically at the 10th of a month. And the reason we do that is typically if you bill on the 20th and you should get paid 45 days later, that's going to be around the 5th or the 10th is what it should be. And then it takes you however many days to turn around and pay everybody. So a lot of times, obviously, you don't get paid on the 5th or the 10th. You get paid on the 15th or the 20th. And then you start to resolve those balances. So about the 10th is when it maxes out, give or take a few days. If you are getting paid earlier, just do it a little bit sooner than the 10th. Whatever your highest balance kind of is, whatever day that is on average. It's going to help you quickly compare all of your general contractors based on the same numbers and the same time. Another side note, around the 10th of the month, you should be monitoring your expenses anyway. Because if you're expecting to get paid and then another week or two you don't, you're going to have a lot of mandatory expenses like payroll. And anytime those payments get delayed by a week or two, that's going to really put a strain on your business. So that's just a habit you should be in anyway. From there, you should see the daily cost of working capital by each type for the client that's in orange at the bottom. So for client number one, which we renamed ABCGC, the line of credit portion of based on that company's historical DSO will cost you $25.50 a day based on the balance that we're typically carrying at the highest balance. And the reason I like to do that is I like to build in buffers. Uh, I don't like to push company finances to a best case scenario for the sake of winning a project. As a former project manager, and as anybody knows in construction, it's a lot of risk to assume that a project's going to go perfectly from the field work getting done on time, getting material in. Um, it's not delayed. There's nothing else that happens. Um, then we're gonna move on to the next part. It's the two credit card types. One has a 0% interest rate, and that's something we use monthly and we pay off monthly. Like you're getting fuel, you're getting day-to-day material like wood at Home Depot or something. And the other one is 2.5%. And those aren't your credit card interest rates, but what that is you're simulating a 2.5% convenience fee if your superintendent goes to drive and pick up material on will call without a purchase order. Hey, I'm just gonna say a blanket statement. We don't use credit cards to bankroll everything because those rates are 20-30% depending on your credit score and which one you have. So you always make sure if you're putting on a credit card, you're using it like a debit card, like you're paying it off monthly. Going to the bottom section, you can see the daily cost of financing overall for the client based on a 30-day month would be $163,875 based on the dollar amounts that we are bankrolling for as a company. So the way we can narrow that down to this specific client is you take that 163,875 divided by your average monthly balance, all totaled together. So in this case, it's going to be 5.01%. That will cost you daily, based on 30 days, 0.17% to work with this client. Basically, that's a ton of numbers, and you probably don't care about any of them. Most people don't. But I'm a why kind of a person. I want to know why should I trust this? How do I know this actually means anything? And I want to know what the data is actually telling me. So that's the backstory of how we got those numbers and why they are credible to your specific company. Next, we're going to look at the orange cells, and we can change our client because there's a drop-down menu with all the historical numbers referenced from the tab before. So wherever you change the name, this is where it comes in, and then all of the data that you entered in, all the average DSOs, those automatically populate based on all of these numbers now. So for ABCGC, with an average DSO of 34, the percent we need to add to the bid to account for the cost of capital, or in layman terms, basically, if you work for ABCGC, who pays 34 days, it's going to cost you to work for their job an average of 5.74%. That's not project specific. That's just an average of what you typically carry for a balance. So what that helps you do is decide, okay, ABCGC cost me 5.74%. What are the other ones cost me? So we're going to look at client number 4. You can see that if you change it to client number 4, the bid's it's gonna say that it's an 8.76%. So basically, if you think about it, the way construction industry works, typically it's a 10% overhead and 5% profit. That 5% profit is completely eroded if it's over like a 30-day payment term. And if it's 30 days, it just uses all of it. So you're not making any profit. You're just financing the job and doing work for free. Um, but if we work for client number 4, we're actually going to be paying 3.76% to do projects with them based on historically how long it takes them to pay us and the balances that we carry. Um, I just want to make this a little more real for you. If you put those percentages into a tangible thought, imagine a $1 million project. That means if you did a $1 million project, however long that took you, a year, 6 months, you are actually paying out of your company $37,600 instead of making a single dollar. And that's if everything goes perfectly according to how you estimated it. So if you said it was going to take 1,000 hours and it took 1,500 hours, you're paying 37,600 on top of everything else you're paying because the work didn't get done in the right time. So basically, if all the stars align, you're still paying for a project. Really, this is why calculating your cost of capital is not just important, but it's a must because your bids could look like you're making 15%, but you could be paying for projects just because of the payment terms that you have negotiated and how you leverage your working capital. This calculator is a tool that you need to use to view your finances, and you can make data-based decisions instead of going off of that gut feeling or emotional decision in the bid room thinking, oh yeah, this is a good client of ours. We need to take a little off and shave it here because they pay us well. This will actually tell you, do they pay us well? How well do they pay us? And is it going to really screw us or not? So I want to do a poll. Have you been paying for projects without realizing it based on payment terms and not looking at project by project specific costs? If you think about it, if you look at a project by project, it might look like, hey, on this project, we're trending well, we're making 5%, but you won't know that because if you're not being paid for 34 days, you're not tracking that in your project by project cost. That's not a cost code. Um, all right, I'm going to take a break here. I'm going to get some water. There's a lot of talking. All right, at this point, you're probably thinking, this is all great information to know who I should focus my business development on for clients. But now you're probably really interested. How do I actually use this data and quantifiably know how much do I add on the next project bid? Because every project is different. I can't just put a blanket statement and say, this project is going to be a 5.76% adder because now it's a public works or now it's a CSIP or whatever it might be. And you know that it's going to drag out longer. So how do you actually, and you don't know what the cost of how much is actually going to be expensed to each. So how do you actually know all of that? And that's, while we look at tab number 2 is more for business development. That's a good way to identify where you want to go and focus energy. Tab number 3 is something that you implement in your estimating department to calculate based on specific projects that are coming up. So we'll go to the final tab, number 3, calculating on project basis. You'll notice currently there are 16 yellow cells built in, plus our client cell at the bottom, which you can manually, use the drop down. So say you have a bid, you're doing this project bid, and you're gonna quote it to 3 different clients. Client number 1 is your best, 2, 3, and you know the adder for each one. Because again, not everyone's gonna cost the same. If one pays you in 34 days and one pays you in 60, it's almost double the amount, and you're gonna find that out here. All right, sorry, where was I? But at this point, instead of using averages like we did in tab 2, we're gonna actually start to put in specific working capital option and exact interest rates for each line of credit, credit card, etc. So to do that, you want to right click on a row on the side that has data in it and above it. And what that does, it helps you have the formulas auto update at the bottom. If you add it at the bottom, it won't do that. And if you have any trouble with these Excel examples, I'm sure somebody in your office knows how to do it. It's pretty simple, or you can Google it. But right click on a row and then push insert. I personally like to fill this out with lender names instead of saying lender one. You can say Wells Fargo, for example. Or if you use Wells Fargo for 4 different credit lines, you can put Wells Fargo and then the last 4 digits of the credit line, depending on what you're doing. Um, that's just to help you in the long term. Helps make it a little more clear. All right. So we're going to start with the total bid expenses. So when you have your estimate, you're going to know what's the selling cost, right? How much am I going to sell this to the client? But really, how much is this going to cost me to build? If I know this is much for materials, this much for labor, that's what we really care about. So add up all your expenses and put that in the first cell. Mine is going to be 1.7 million of estimated cost. Again, not the bid amount, but what it'll cost us before overhead and markup. Next, we have $200,000 populated for expenses projected financing through the line of credit XYZ lender. So again, if that's Wells Fargo, we plan on putting $200,000 through them, and maybe that's for our labor, because a lender is a little more flexible than others. And as we populate the interest rate, because maybe you have 4 different lines of credit, everyone's going to be a little different. Which one do you want to leverage for this project? How quick does this one pay? Maybe you can negotiate some numbers a little lower so you can get a better bid. But the red cells are going to auto-calculate and update. The goal is to plan the full amount of bid expenses for a project from an estimate and match that total in cell B5 at the bottom. And I have it automatically calculating that for you. It's time consuming, but it helps you have a plan so you can strategize. How are you going to pay for other potential projects that are coming up? If you're maxing out a credit line, you need to know that in another one that you don't have that available fund, or you need to look ahead and start to get more lines of credit, right? If you're not sure who you're going to use on a project, I personally like to plug in the highest interest rate of all of my lines of credit so you can cover yourself in case you need it. Um, a lot of business owners that I have worked with and for, uh, they hate that because it's like estimating is supposed to be, how do I slim down as much as possible because I need to win this job? But think of it this way. If a GC comes to you and says, hey, you're 5% high, that doesn't necessarily mean you are wrong. That might mean that your competition, the other person bidding this, has scope gaps. Or maybe they aren't quoting the same stuff as you. Maybe you're doing control wiring, but they're not. There's a lot of different things. So what you need to do is trust your process, trust your estimating process and your estimating team that you're doing it right and stick true to your numbers. Looking at the daily cost column for $200,000 on the line of credit with XYZ lender, the daily cost is $600 per day to use that line of credit for that dollar amount, from the day that you spend to the day that you have the money to pay it off. So this isn't like a revolving thing. It's a, when you spend that 200,000, you're not ever going to re-spend that 200,000. You're going to pay it off within probably 45 days. Whatever you get paid, you're going to pay that. For the cash line, we want to think of that 5% as lost opportunity. The lost opportunity is a concept, like a theoretical thing, but it could be putting money into stocks and bonds. It could be acquiring new assets, like new vehicles. It could be maybe you want to implement a new training program, trade school. Maybe you want to do some new software, whatever it might be. We're going to average that to 5%. If you think that's off, because stocks and bonds, it can go up to 30%, it can go down to negative 10%, but on average, it's like 8. So 5% seems very reasonable. If you think it's off from the time that you're doing this, if maybe the stock market changes quite a bit, you can change that to whatever you want, but that's why we use that number in this example. After all the information is entered, the bottom 5 cells are where really the magic is going to happen for you. Using the orange cell, select the customer by name that you named in the first tab. And so, for example, when I select ABCGC, this project is estimated at $1.7 million for expenses. We might be selling it at $2.5 million, 2.1, whatever it might be, but it's going to cost us 1.7. We plan to use 8 different working capital options, and they're all listed above. We're going to use some of it for cash, like month-over-month expenses when it's wood, fuel, whatever, labor maybe, and all of those up top. And the daily cost of how you're leveraging those, how much you're putting on each one, is calculated in column F. So adding all of column F together, ABCGC with an average DSO of 34 days. So basically, again, ABCGC pays you within 34 days on average. This project, the way it's allocated, will have a daily cost of $2,200 to finance the project based on the way that we're allocating the expenses. Again, you can change them, move one from material financing up to a lender rate, whatever you might want to do. But currently, that's what it says. So at the end of the project, because you're paid every 34 days and somebody has to pay your lender the interest rate, that's going to cost you $75,625 to build this project the way that it's distributed the working capital currently. So how do we actually account for that? It's not something that in your project accounting, your PM is going to say, okay, well, this month we paid our bill a little early, so this is how much it's actually costing us, right? So what you do is you take the total bid expenses divided by the estimated cost of financing total, and you get a percentage to add to your bid. So at the bottom, it does all of these calculations for you. In this case, the adder we want to use for ABCGC's proposal is 4.45%. That would cover that $75,625 that it's going to cost you to finance all of the material and labor and lost opportunity and everything for this project that is hidden costs that you didn't that have always been there, but you didn't know were there. So I want to give you the example. We're going to look at client 4 again. They want you to bid the same project. You have these 2 GCs, they're competitive. Typically, people just give them the same price, right? For you, it's 2.1. For you, it's 2.1. Well, if one's going to cost you 4.45%, you're only going to make 0.55% profit if everything goes perfectly and all the stars align. What if we work for client 4? Their average DSO is 52 days. So it's only 18 days more. It's only 3 weeks, not even. That doesn't seem like it's a really long time. But the daily cost, that's going to be the same, right? It's still going to cost us the same the way it's allocated every day. But because it's taking them 52 days instead of 34 days to pay us, the cost of financing total goes from $75,625 to $115,400. So again, if I am doing this project for 2.1 million, I'm actually going to slim my margin past that even more. That's 53% difference, or $39,775 additional that you are paying for interest because they are paying you 18 days later than the other client. That's why no client is the same. No, and you have to make sure all of your data getting to this point is correct. The worst part to me of this whole scenario is the average DSO for subcontractors. According to the 2024 subcontractor market report that Build does, that's actually 57 days. So on average in the industry, 57 days, and we're messing around with all our calculations and we're looking at 52 or 34 days. So really, we need to account for this because it's probably 8 or 9% for normal people. Um, so for client number 4, you're going to need to add that 6.79% to account for the cost of financing the job based on their payment terms, on how they historically pay you. And this is all data that you've had the whole time, but you might not have even realized it. And that's why your project estimates seem to be profitable, but when it comes to tax time, you're actually losing money, or it doesn't look like you're making as much as you should. So I want to know, what's your ideal client's percent that you need to add to a bid that you have not been doing? And leave a comment. How much money have you been leaving on the table if you did a $1.7 million project with that best client? All of this to say, 6.79% that we're adding for client 4, which is below the industry average. And we're using, if we're estimating with an average of 10% overhead and 5% profit, that 5% profit is completely gone, and we're actually paying 1.79% on a $1.7 million contract, like the expenses. We're actually paying 1% of that, almost 2% of that, actually. So there are several ways to add that percentage to your bid. It's not, you can, it depends what you use. When I was in electrical, we had software that let us add a percent. If you're using Excel, you can do that. Just add it somewhere at the total before it gets to the end, before it does your overhead markup. And that's how you can do all this. But I can't stress this enough. Accounting for the cost of working capital is critically important. And again, this will be available that you can rewatch and actually sit in your office and make it a priority to enter all of your data correctly and follow along a second time. I know it took a while, but it's really important to do it. 2 action items from this part of the live stream that I want you to do are price out 3 more working capital options to add to your capabilities and request an increase to your credit limit so you can use your more lucrative options more often. And with that, I'm going to take a water break before we move into how do I look at what what do I want to use? What do I recommend as a CFO to my clients of how they should leverage each one? All right. So now that you have your best clients that are based on actual data of how quick you pay and all of that, and you know how much you're going to add to your next bid for that client and for each client that wants you to bid that project, the last advice we're going to go over is how to look at it from like a fractional CFO or an executive leader's point of view on which capital option, or which working capital option do I want to use for this project and how much do I want to use on it. So I want you to leave me a comment. What's your go-to working capital option? Do you favor a specific lender? Do you favor supplier terms? And why is that? Do you think it's because it's the most efficient or it's the most convenient? A lot of times people will use their supplier terms because they don't have to go pay it from another one and then push the cost over, but those supplier terms might cost you more. With this topic though, we have to start with the understanding that construction is volatile. Nothing ever goes the way it should. Schedules change, circumstances change, existing conditions change. Almost anything can change. Your employees, your leadership, everything can change. So all that to say, give yourself grace when you make a decision with the information you have at the time and just reevaluate as you go. But know you're rarely, if ever, going to make the perfect decision in the moment, and that's okay. The goal is to make a good decision, not the perfect or best decision. I found that if I focus on finding the best decision, I end up stalling and costing more than if I would have just done something that made sense at the time. So using this example that we have pulled up, let's say I want to show how I'm going to expense this entire job. I think about a few things to start. How long is this project going to be? To know how quick in relation to when the capacities will be needed for other projects. So basically, if I put $200,000 on the line of credit for labor, but I'm going to be using that in October, do I have another project in October that I'm also going to need money for that line of credit? Um, and I don't want them to overlap because I only have a $300,000 buffer or limit, right? How often will we bill? And can we bill for stored material so we can leverage our stored material cost with the vendor to reduce how much is tied up in our bonding capabilities as quick as possible? So if your bonding capacity is $10 million and you sign up for a $6 million job, you can't sign up for another $6 million job with your bonding company because it's still out there, right? But if I buy my $5 million of material, or sorry, say $2.5 million of material, I lower my bonding capacity and I can take on another $6 million project because I've reduced it from my first one from 6 to 3.5 million. So I can also take on my $6 million project, if that makes sense. And the way you do that is you can buy all your material up front. If they store it at the vendor, then um, you're not paying for the material. You're not invoiced for it until it arrives on site. And typically that's just commodities. If it's like when I did electrical, we're talking like wire, we're talking EMT, pipe, PVC, whatever. If you have something specific that's custom order, like switchgear, generators, in your case, it could be anything that has a submittal that's not a commodity, then those are things that you will probably get billed immediately for. But once you receive it, you can bill for it. And once you bill for it, now it's no longer a liability, right? Now it's committed cost, paid for cost, and no longer have to worry about the cost of that material changing. Are there any projects coming up that we may want or need to leverage specific working capital options? Do we have time between now and when we need to use the money to increase our credit limits? And the last one is, since I have a project management background, that's like where my mind always goes. I always think about, do we have contractual and emergency fund protections to get through large time and material sums or unforeseen costs to front money for potential extended amounts of time? So, one of my worst examples that I've ever come across is for a civil contractor. We did 2 months worth of time and material because existing conditions were different. They were wrong than what was in the bid. We were told, proceed time and material, do it. We do it all. Third party engineer, do all of it that way. But they decide they're not going to pay that 2 months worth of operating expenses for 6 months. So that $300,000 drug out for 6 months. And for a $5 million company, that could be all of your profit for an entire year if you're not doing things well, if you're not doing things right. So it's really important to know, do I have an emergency cash fund that I can absorb those hits? Or do I put something in my contract that says, hey, I'm not going to exceed 1% of total contract value in time and material without it being processed and paid first? Just things that I've done in the past that work really well. Um, that one is really tough because you always have change orders. But the difference between a change order and all of that, the problem that I brought up, is how quick can we submit costs and actually receive money for them? But okay, so for this example, we're going to assume this project is standalone. There's no extenuating circumstances to worry about. Uh, I'm going to look first at our capability and our payment terms for each line of credit. In the 2024 subcontractor report that Bill publishes again, they found 73% of respondents have terms that are only 30 days for them to pay their suppliers or vendors or whoever, subcontractors, while they average 57 days to get paid for those same materials and labor and everything else. So basically, you have to front the cost of all of that. Um, Subcontractors are notorious Everybody says it, that we're the banks of construction, and it's true because we're funding money to build these projects when it doesn't have to be that way. Money doesn't have to take 57 days to go from the owner to the GC to us. Not that big of a deal. Doesn't take you that long to pay your electric bill, so why does it take that long for everybody else? It's really important to factor in when deciding if we want to pay interest on materials. Um, like, do we want to pay for this up front and pay the interest? Like, if we don't pay it within 30 days, we have to pay this 3 to 7% interest, right? Do we want to pay that? Um, or do we want to pay them off? And what the difference is do you want to accept the liability of you have to lien the entire thing, that whole cost, or do you want to leave some of it for your vendor? So if your vendor is carrying a $300,000 bill, do you want to let them lien for that 300,000 so you only have to lien for your labor portion and everything else, or do you want to assume all of the risk because that's your relationship you want to maintain? Um, a tip again that I do when I do project management is order 90% of your material as soon as the job contract is executed and submittals are approved. You have to make sure they're right and they're okay to use. But then when you implement the billing strategy of as soon as the submittals are done, 10% of that material line item. And as soon as all the material lands in the warehouse, bill for all of it immediately. That reduces your risk immensely and it gets it off of your plate pretty quick. Um, so when we're doing that though, what you want to do is weekly deliveries against material that you've ordered to store in advance. So you're already billed for it, you've already paid for it, but they'll just send it to you. Sorry, you haven't paid for it. They'll send it to you and you pay for it as you use it. And if you don't use those commodities, then you're never charged for them. They just store them in their warehouse because everybody else uses them. Typically though, that again only works for commodities. Next, obviously we're going to take into account what's the lowest interest rate for each type of working capital. But what's more important than what's the lowest interest rate is how flexible are my options? And we want to maintain the most flexible options for when we need them. So just because the flexible option might be the cheapest, we might want to save that for that rainy day if we have to pay for labor, but we're not getting paid on time because there's a holdup for some reason. Maybe there's a holiday weekend, something like that. We have to make sure everybody gets paid still. So you have that flexibility. Cash is typically going to be a cheaper option. But if you have a lot of projects coming up, you might want to keep your emergency funds at a certain level, uh, and press into like a line of credit because when you start a project, if you want to take on that next level project, you're going to need to have $300,000 to do a $5 million project, and if you've only done a $2.5 million project, you're not going to be able to front that much because you don't have the working capital capacity at this point. So you want to save up that 6 months of emergency funds. Credit cards, again, are something we typically only use for direct job expenses. That's direct job expenses, things like fuel, paper plans, or things that are needed to be bought immediately that are relatively cheap. Again, think Home Depot runs for screws, washers, boxes, fittings, wood, all the things that everybody needs on a job site, but you don't really estimate for it. I personally hate using credit cards because you can't forecast how much will get spent until you reconcile a credit card statement. Versus the opposite, if you commit a cost in a quoted PO from a supplier, you'll get better rates, and all of that then gets invoiced, but you've planned for it. And when you put a purchase order in, it shows as a committed cost versus if you spent $15,000 on a credit card, you won't know until you get that credit card statement, most likely. I get small companies do it because it's easier, but in my experience, too much money gets lost or wasted on things that aren't necessary, or they're not even for the project. Maybe they're for personal use. Somebody fills out their personal gas tank. There's also the cost of time and gas for someone to go to the store, and it becomes a habit of reacting. And if you're not planning, your superintendent is wasting their time going to the store, and you have people standing around for 3 hours waiting for the superintendent to come back with the material. So for every person under them, you're just wasting all that time too. Next, I consider the cost of material financing. Um, a company that does it really well, obviously, sponsoring this, Build, they give you the ability to pay the supplier up front. So when you pay a supplier within, say, 30 days, you get a discount. But then Build gives you 120 days to pay it back. So maybe Build charges you a small percentage, but you got 10% off your bill for the supplier. So it actually works in your favor and it gives you more extended time. It's just another working capital option. A good strategy in deciding when to pay early versus holding a payment, like, do I want to pay for this material today or do I want to wait? Is you want to have triggers in place so your team can decide immediately. You don't want to have them waiting for meetings, because then instead of one person just doing it in 20 minutes, you have 4 people taking an hour to have a meeting about the same thing, and it could have just been done. But that's just my opinion. Each situation's case by case. Other factors that weigh on a decision are what are the credit limits? You might want to add a column to your spreadsheet that says, hey, this credit limit is 50 $50,000. This one's 200,000. So that way you're not overextending one of them. But again, that's kind of a wrap on what I do, what I look at. There's some other nuanced things, but with that, we're gonna take some questions. Uh Again, all of this is tangible data, so it's not just my opinion on how money flows in and out of a company. I know that all of this was really in the weeds. It's it's all about a process though of how you target your ideal client, how you put that, figure out how much they cost to finance a job, and then how you can leverage your options to do all of that. And now we're gonna move into a Q&A. I'm gonna be joined by Mark, or with Mark Reyes from Build, and we'll answer your questions live.